welcome to the Self Storage Made Simple podcast. Really excited to welcome to the show somebody who was kind enough to have me on their self storage podcast, ever present in the industry, somebody who I've enjoyed following on social media and following his podcast. Is a principal in passiveinvesting.com, is in charge of their self-storage section, a super successful real estate investment company, somebody I'm excited to dig into about the state of self-storage today and see where the conversation goes. So Chris Bennett, want to thank you for coming and joining us on the show.
Thaddeus, thank you for having me on. Appreciate it.
So first thing I always ask is, because self-storage is such a niche in the overall real estate market and anything you want to look at for asset classes, it's such kind of like a hidden gem, although it's starting to become more well-known. Always love to hear how people found themselves in this little corner of the world.
Yeah, absolutely. So going back to my time in school, actually even before that, I didn't want to have anything to do with real estate because I did real estate since 2007, went through the recession, and that just really sucked. Anybody who was around during that time knows that it was not fun, and real estate was the worst thing you could possibly be in. Went to school, long story short, went to school. Only job I could find was in real estate, but working for a guy who was doing private equity, like basic syndication through a couple of funds. I had no idea what that is. I had no idea what he was doing. I just knew he was buying apartments. I had no idea how he was buying it. Is this guy a billionaire? I have no idea. But he wanted me to do some underwriting for him in Excel. So I did that. He showed me the ropes. And man, I realized the light bulbs kind of came on. I realized, wow, he's raising money to go buy these deals. He's buying, apartments. So call it 300 units at one time. All I had known up to that point was single family homes. And I realized he's buying 300 single family homes essentially at one time instead of doing it one by one by one by one, which would take a lifetime to get to 300 units. So the light bulb came on. Use other people's money to go buy commercial real estate. Fast forward, I graduated, worked for a company called 10 Federal. A lot of people in the self-storage world know about that. I was around. We did our first fund. I was there when the Da Vinci lock was made. We were trying to name it. We're in the conference room. The intern came up with the name at the time, so it was kind of funny. So I've been around, and we were doing multifamily acquisitions. That's what I was doing. We pivoted to storage, and I realized, oh my gosh, there's opportunity within storage to buy mom and pop facilities. If you want to add technology, automate them, whatever, you can do that. You can run them the traditional way where they're managed or whatever. But the point is, I realized there's an opportunity here where you could buy 200-300 units at one time, even 100 units at one time with the same amount of money that it would take to buy 10 multifamily units. So I realized, oh man, there is opportunity here, and there's fewer institutional players, way fewer in the self-storage space than there are in the multifamily space. So I was like, you know what, I'm going to make a pivot and focus here. And that's what I did.
I love that story about the light going on. Take me back to school. So I'm a little jealous because you went to University of North Carolina at Chapel Hill, correct?
Yeah.
So real quick side story. I went to Tufts University, which is in Boston,
Oh, nice.
great school, but cold as all get out from like a month into school, if you're lucky, until like 2 weeks before school graduates. So I went down to Chapel Hill for spring break one year, but it was my junior year of college. If I had gone there earlier, I would have transferred 100% because the climate down there is just fantastic. That's a total side story, nothing to do with what we're talking about. But tell me what you studied when you were there.
Business and economics. I initially went because I didn't want anything to do with real estate. So I actually went into what's called mathematical decision science, which is what I call super nerdy Asian math stuff. I'm half Korean, so I can say that. Bro. So anyway, and I was studying that, and I realized, number one, not all Asians are good at math, including myself. And number two, I don't want to do this for a living. So I decided to make a switch, went to the econ direction, and actually loved that a lot. It's actually a social science, not necessarily a mathematical thing. But I really enjoyed that. And then wasn't sure if I wanted to double major or major minor, whatever. So I minored in business. They have a real estate fund there as well that's student managed. It's at the time, it was the only one of its kind in the US. There's been some other schools that have come down and observed and tried to figure out how the university did it and put it all together. And then they started their own version of that. But when I was there at 2016, this is 2015, 2016, it was managed by students. So we had $3.6 million of real LP capital from alumni of the school. And the number one mandate was education. The number two was get a return. So it wasn't we were trying to lose money, but the number one mandate was get an education, which is an interesting way to look at funds from LP investors. So when we invested in everything from multifamily to retail to self-storage. I think we did a senior housing project as well. So you get to see a wide range of types of real estate. And so that's what really, I studied economics, but really got a good lesson in private equity, syndications, funds, et cetera, while they're at school.
I think that's absolutely fantastic. It makes me even a little more jealous about your journey to Chapel Hill, that you have this chance to go do something real, right? Like you're and not a small amount of money. A $3.6 million fund gives you some legs to go do some stuff.
Absolutely, man. It was great. It was obviously education. It was kind of it was like being thrown into the fire. It was the most difficult. You have to interview for that. So you have to interview to get into this, interview, you apply to get into the school in general. And
Yeah.
then you have to interview and apply to get into the business school. And then to get on the fund, you have to interview and apply and interview to get on the fund. So it's like a 3-step process if you want to do that. And it was the most grueling interview to be for the fund. And when I got the phone call, I was like, oh my gosh, I was, astounded that I actually made it. So it was a great experience. Obviously, it was an eye-opening experience as well. So, and it helps like connect people, with each other. I still have friends on LinkedIn, et cetera, from that time. I see them. There's a conference that the school puts on every year as well, a real estate conference, pretty popular amongst all the institutional folks. So we go up there nearly every year and kind of have a little reunion. So it's a lot of fun.
All right. Next time that happens, I'm going to ask you to give me a heads up, because I'll always take an excuse to head down to North Carolina. It's not
Bro,
that long to drive. I can make it there pretty quickly.
Oh yeah, man. Go to a Carolina Duke basketball game or something like that. As a quick aside note, that's what I have a different opinion on education. A lot of people, the Grant Cardones, I completely disagree with him, with Gary Vaynerchuk, with all those guys about education. I think if you do it right, and that's hard to do. I'm not saying everybody can figure it out the right way, but if you do it right, you don't be lazy, you focus. I worked my tail off in school trying to get a job, trying to get myself prepared for the next step. If you do it right, it is absolutely worth it. If you go to the right educational institution, it's also absolutely worth it. If you go to the bottom 100 colleges or universities in the US, it's probably not worth it unless you're studying something that they specialize in, like regionally. A lot of colleges will specialize in whatever it might be, but for their region, getting people jobs in that trade or whatever it is. So I completely disagree. College is not a waste of time. It only is if you do it wrong. The same thing with the military. People go to the military, they stay in 4 years, they absolutely hate it. I can't wait to get out. Then they go get a job and they realize, 20 years later, I wish I would have stayed in the military, because it wasn't a waste of time. You just wasted your time. So that's my view on education and all that stuff.
I want to expound on something you said, which is you said it's not a waste of time if you do it right. I think where we have an issue, and quite frankly, I'm a victim of this in my own education, and I'll go down this road since you opened the door. I went to Tufts. I was a New England prep school kid from the time I was in 6th grade. I was lucky enough to have a private school down the street from my house. I got in, kind of similar to your story about going into the real estate fund at North Carolina. Was like, holy cow, they let me in. That was the expectation, right? It was like, hey, you're going here to go to college. What I didn't have was an understanding of why I was going to Tufts. Now, my journey turned out all right. It worked out okay. But I went to Tufts and studied English and history because I didn't know. There was nobody in my ear saying, hey, what do you want to do? Why do you want to do it? What's the best thing for you to study if you're going to go down that road? And so I sort of just wung it through. I was working 20 hours a week the whole time I was there. So it's not like I wasn't busy, but I didn't do it right. Now, I was lucky that I went to Tufts, and there's a certain gravitas of having that on your resume. And so it served me well since then. But in hindsight, I 1000% agree with what you said. Number one, what school are you going to? But number two, why are you going there? What's the purpose of the education that you're going to get? Because if you're going to college to experience college in this day and age with what it costs you to go to school, like I think Tufts right now is $72,000 a year. And I haven't checked for a couple of years. It might have gone up since then.
Yeah.
That's a big chunk of change to spend to go experience college life.
Yeah, I don't think that is probably the right way to do it, just to experience. Like, I'm not saying you, but I'm just saying in general, for someone to just experience college, whatever. I'm actually a fan as well of students taking a gap year, where they go and they I don't know, whatever they do. They want to work, they want to travel, whatever it is that, that they can do during that time. I think it's actually worth it. I also think it's worth exploring different careers, different things, because honestly, as a 20 something year old, it is hard to know what you want to do. And probably what you want to do in your 20s is not going to be the same thing that you want to do in your 30s. Just like toys I played with when I was 5 are not the same things I wanted to play with when I was 15. Right. So you change. We'll both be different. Everybody listening to this podcast episode will be, generally speaking, a different person with different wants, needs, and desires in 10 years from now. So it is not easy to narrow it down, but you do want to pick something through some sort of experience where you realize, okay, I like this. I can do this for another 3, 4, 5 years. I really enjoy it. It, puts my skills in whatever it is to work. Hopefully that's something, whether it's in business, math, engineering, whatever it is that gets you medical, biology, science. It doesn't matter what it is. As long as it gets you somewhere, it's worth the education. If it costs $75,000 or whatever it is, Duke is expensive. Carolina is a state school, a little bit cheaper, but still expensive, thousands of dollars. If it costs that much to go, they would talk about it in classes. They say in our economics classes, the only reason you're foregoing the opportunity as you're there for 4 years, you're foregoing the opportunity to make money. You're foregoing whatever your potential salary was to get an education, because the reason is when you get out and graduate, your income level should be higher. And so that's the only reason why you do it. Yeah. If you're graduating and to go do whatever the heck it is, work at Starbucks or whatever, it is not worth going to college. You're going to waste your time, effort, and money. Because when you get out, if you're not getting that salary bump, it's not worth it. It doesn't make any sense.
I'll never forget. So I went to Tufts and I got an English and history degree. And of course, then my only option was to go to graduate school because I wasn't going to, I didn't want to be a teacher. Went to Syracuse, got a degree in broadcast journalism, but again, no mentors, no research. My first job out of Syracuse, which, humble brag, #1 broadcast journalism school in the country. I'm thinking I'm going to be making 6 figures, right? I made $15,000 my first year out of Syracuse.
Oh my gosh, right? So, bro.
I want to kind of, yeah, exactly. Right. I think my 3rd year in television, I got out of television after 3 years, but my 3rd year I made $26,500. And then I was like, this is not the right industry for me, having nothing to do with the income, because I could live off that. But I just didn't enjoy it, which is a whole nother thing we could talk about. But where I wanted to talk about, because you said something fascinating, and I think it's why I love ground up development in commercial real estate so much. You said in college, you forego 4 years of potential to make money. Why? Well, it's that bump you expect to get on the other end, right? And so this is what we do, right? We invest, even if you're buying value add, especially today in a lot of situations, we're seeing things trade at negative leverage. Investors are not necessarily going to see an immediate return on their investment. They're going to forego that in order to ostensibly make a bigger return on the back end. I thought that it just kind of tied into something I've been thinking about a lot lately in terms of what we do.
Absolutely. Yeah. It's the risk return trade-off, right? So you have your core type asset where it's going to be low returns, but low risk, hopefully. All the way on the other side of the spectrum is your opportunistic development, where it's 0 returns while you're developing, or maybe it's a value add or whatever. But the point is, it's very low to 0 returns with the hope and expectation that you get that big bump when you sell later on, or get your C of O and sell, or maybe get your C of O, lease up a little bit, and then sell. So at some point in the future, you're hoping to get that big bump. Investors have to think about that, right? So like, what's their bucket of capital look like that they have? Maybe they put it into a core type deal or a core plus or whatever it is. But the point is, you have some sort of return. And then the other is a little bit more, not speculative, but a little bit more risky, where you're saying, okay, I think this is a good deal, this development deal. We expect to get X return in 3 to 4 years, or whatever the expectation is. And I think that, you have to think of it that way. It is a risk. Going to college 100%. Is a risk, because anything could happen. God forbid you get hurt, whatever, something happens, you drop out. Now you have student loan debt and no degree, right? So there's risk there that's involved. So the same thing with development. It could take much longer, cost much more, and now you have to sell it for a lot more, and then interest rates are higher, and now we have, oh crap, now we just, we have to hold this thing longer than we expected. Nothing you can do about that. It just is. You have to think about those things before you jump in.
It reminds me of a call I had with an investor a couple of years ago on a project, and they said, well, what's my downside risk here? Because the pro forma looked really nice. And I was like, the downside risk is you lose all your money.
You lose all
That's
your
the
money,
downside
and
risk.
if you're guaranteeing the loan, you lose more. So
Yeah,
people don't realize that.
yeah,
Yeah, people don't realize that your returns on real estate investing are actually can be negative. It
right.
can dip into your personal financials. So there's a lot of risk involved in real estate investing, whereas investing in the stock market doesn't quite carry as much risk. A lot of syndicators, I get it. I understand why they do it. They'll poo-poo the stock market. I get it. Like I totally understand what they're saying when they do that. However, on the other flip side of that is if I buy Nvidia stock, with the AI boom right now, if I buy some shares of Nvidia or I really like Tesla or whatever, and I buy some shares, well, those shares can go to zero and I've lost my investment, but I didn't
Right.
lose my house,
You
right?
didn't
And
sign a
so,
recourse debt loan where all of a sudden
no,
the bank's guaranteeing your construction loan on a development project against your personal property, and you've lost more than just the investment.
exactly. LPs generally don't have to worry about that too much, but it is still there, obviously, on the GP side. And anybody who signs a loan guarantee, it can be a negative return, right? Extend much farther beyond the money you actually put into the deal. So there is risk. Got to think about that.
I love that you bring that up, and I think it's one of the reasons that you and I vibe and get along is because you always think from the perspective of the investor instead of thinking from the perspective of yourself, right? Your professional job is to go out and find self-storage deals for your company, and then of course that's a vehicle for investors to go invest in and hopefully make a return. But you're framing it from the perspective of the investor. Hey, this is not like we're not dealing with projects that you want to put your last dollar into.
No, not at all. You have to do what's good for you, not what's good for me. And I learned with the perspective of the investor, with everything that I do, podcasts, posts on YouTube or on LinkedIn or wherever it might be, webinars, etc. I try to put myself in the shoes of the audience. What's in it for them? What makes sense for them? Because ultimately, nobody cares about my story,
Right.
only insofar as much as it helps them advance their story, right? And so nobody cares I went to college at Carolina. Nobody cares about any of that stuff. It's what did you learn from that? How can it help me reach my own personal retirement goals, investing goals, etc. Sometimes you can see yourself in somebody, and so in that sense, you do have a vested interest in their success. But for the most part, if it's us, you see us online, our ads, whatever it is that we're doing, looks just like anybody else's, right? What's the difference? We're a commodity. What's the difference? Obviously, the personal connection, no like and trust, et cetera. But beyond that, how can you help me? How can you, Mr. Sponsor or Mrs. Sponsor or Mr. Webinar person or whatever it is you're doing, podcast guy, podcast guru, how can you help me advance my personal goals? And then from there, they can resonate with your story, et cetera. So that's why I try to put myself in the shoes of the listener, the watcher, the reader, whoever it might be, to try and help them. Zig Ziglar, if you remember that name from back in the day, I used to sell cell phones back in the day, and so I listened to his Secrets of Closing the Sale on disc.
Yeah.
Believe it or not, CDs in the car and all that stuff.
Oh, that's
But
great.
he said on that, you can get everything in life that you want if you help enough people get what they want. And I never quite understood that until like obviously a little bit later on. I was like, I don't get that, but now I do. What are people looking for? Help them get it. You'll get more of what you want.
That's so cool, man. I had a mentor. I taught martial arts for many years. You were talking about 10 years, and I was thinking when you said that, like, we're going to be in a different place 10 years ago. 10 years ago, I got hurt and I gave up. I owned a school, right? I had a martial arts school that I taught at. And, look at 10 years, how far. And so that resonated with me, what you said, because I'm in such a different place. But going back to my martial arts career, when I first bought my own school, I had a mentor, Joe Curran, who was a super experienced martial arts instructor. And he said, Thad, don't worry about counting your money. Don't worry about how much you made at the end of the month. Worry about making your students great at whatever it is they came in your school for, right? And that never fails. If you do right by your client base, by the people you're trying to serve with whatever it is you're selling, it's always going to work in the long run.
Absolutely. Yeah, I think sometimes we forget that. I forget that sometimes. So I'm trying
Of
to be
course.
honest here, We all make mistakes, et cetera, get down and get frustrated or whatever, but we try to put ourselves in the shoes of the investor. What's good for them, obviously. We have a fiduciary responsibility to them, right? So what's good for them, what helps them, et cetera. And I think if you do that, you'll go far, right? You'll go far.
I think that that's an apt thing to talk. And it's hard to believe that we're 20 minutes into what I always keep at a 30-minute podcast. So I'm going to pivot a little bit here because the time is flying so fast. And I actually do want to dig in to your expertise in the self-storage world. And what you said kind of translates for me into what's going on right now, because I think maybe a little bit of what we saw in 2020, 2021 into 2022 is some self-storage developers and investors kind of riding that COVID wave in a way where, did we see people get a little too overzealous in how they were underwriting deals and what they thought was going to become a normal series of events on a self-storage investment? So I'm interested to pick your brain as somebody who really understands the writing process and has been in this for way longer than the COVID boom. Did you see that become a problem for people during that kind of crazy run that we saw during COVID?
I did. So a couple things on that. I was at I think it was the Florida. It was one of the shows, whatever. I was at one of the shows, the Self Storage Association shows, and there was a broker giving a presentation talking about deals, deal flow, returns, underwriting, et cetera, and the offers that are coming in and all that. And he showed a slide and talked about how institutional buyers are underwriting a 20% rent increase year one, and then it was something like a 15% year two, and then it was tapering off from there. And my mind was kind of blown, because how in the heck is that sustainable? Did we underwrote some strong rent increases in some cases because they were warranted, right? And so if they're warranted, that I have seen deals where they're 50% below market. So in some sense, 20%
exactly
rent
what I was going to
increase
say.
is
the market
warranted.
is way above the asset you're acquiring. Okay.
Exactly. So, no problem. But these were deals that were in lease up in good markets that were Class A institutional size facilities. This is not like the mom and pop under 30,000 square feet, no website.
Poorly managed.
This is not that, right? So what
Cousin
we're seeing with
Sal,
Class A,
I'm not raising his rent.
right? Not raising his rent on 10 of his buddies who are there for
Yeah.
free. So this is not that. The point is I saw that and I was like, either A, we need to underwrite that way because we're not winning any deals, or B, something's amiss here and this isn't going to work out. And I wish in retrospect that I would have seen, I did not see it this way. I would have seen what's called a reversion to the mean. So in economics, you have, like, if you think of trees, for example, maybe somebody's driving right now, listen to the episode, and they can look out and they can see a tree line. You're going to have like trees that are generally, all roughly similar in height. There won't be too many that stick out much further than the others, right? So they're all kind of, if you measured the height of all those trees, they'd be an average. Some of them would be a little bit below, some of them would be a little bit above, but there really wouldn't be an outlier tree that's like 57 feet above all the other trees, right? For the most part. Yeah. So what happened during COVID was we had an outlier, probably 2 years, where the rents and the demand for storage went through the roof. And I think a lot of us, myself included, so I'm just being honest here, a lot of us thought that it would continue going in that direction. We never thought about the reversion to the mean. In other words, things tend to go back to the average, to the normal, whatever that looks like. If you're of normal height and you have a kid that's 2 feet taller than you, it's unlikely that their kid is going to be 2 feet taller than them or just as tall. It's more likely their kids are going to be shorter than them, right? So there's a reversion to the mean, and that's what happened in the years after COVID. So you had 22, 2023, now 2024. Obviously, interest rates played into that, but then there was a slowing demand for storage, et cetera. All those factors come together to cause a reversion to the mean. And now we're seeing kind of swing the other way, where rents are actually down a little bit more. They're almost where they were before, but down more than where they were before, which, again, may bring another opportunity for buyers, developers, et cetera. You just kind of have to keep your finger on the pulse.
You just absolutely opened up my next question so brilliantly, which is, and I've been pondering this, are we, especially as we hear the Fed talking about possibly lowering interest rates here in their September meeting, and we've already seen kind of some lending come down even without a Fed cut, are we going to see a significant number of distressed properties in storage hit the market over the next year? Or did we miss that possibility of that wave because we're seeing interest rate cuts come quicker than maybe some people might have expected?
I think we missed that because even at our own locations, we saw a increase in demand, increase in occupancy, not quite yet the dramatic increase in rates, but we saw demand and occupancy pick up. So at some of our locations, we're renting like 20 net positive units a month. So there's, obviously it's market dependent. I'm not saying that this is going to be,
still a nice number to hit.
Yeah, exactly. I'm not saying this is going to be everywhere. There may be some, but it is extremely rare for storage to hit any sort of distressed levels. I've seen some, in some level of distress, but it's extremely, extremely rare. So I don't think so. I think we missed that boat. There may be a couple outliers here or there. You just never know. Some sellers may just want to sell because, hey, we don't want to do
Right.
a paid in refinance. In other words, raise money from investors to go and pay down the note, a loan pay down. We don't want to do that. In some cases, you might have to, but those deals are what they are. They most likely won't hit the market. I think we're kind of past that at this point. That's my guess. I could be wrong, but we'll see.
I hope you're not wrong because that's what I believe also. I heard
I
a
think,
weird story today
yeah.
of a needle in the haystack, right? Those are still out there. It was a divorce and it was a 42 store portfolio
Mm.
that somebody was able to get because the husband turned down like six offers, got them under contract and then pulled out like six times. And then one person just like dealt with it and stayed the course. And eventually the court said, hey, you've got to sell these. And they got a cash flowing from day one, 42, smaller stores, but nonetheless, you talked about that idea before about the number of doors, right? Like
Yeah.
you go out and you buy, in that instance, it was north of 5,000 doors. And how much risk do you mitigate by having 5,000 doors instead of five doors? But they're needles in the haystack right now, right? They're
Oh,
not.
those will always happen. The first deal I ever did in storage was a deal in Belmont, North Carolina. It's just outside of Charlotte,
At a
Gastonia area.
university there that makes a run in the NCAA tournament every once in a while.
Exactly. Yeah, exactly. So you got it was on South Point Road. People could look it up if they want. I think the name of it now is like Lotus Self Storage. It's right next to another one that was built later on. But the point is, we closed that one with 10 Federal when I was there. First deal, found it on LoopNet. The picture on LoopNet of the buildings, it had like the roof was like messed up, looked like it was being like rebuilt or under construction or something. It was an older facility, so I was like, something must have happened. Called the broker. He's like, oh no, that's an actual old image. Must be a Google satellite image or whatever. The buildings are totally fine. They had a little storm come through. They rebuilt the roof. They're fine now. Great. Put it under contract. At time of contract, the husband had passed away 6 months earlier. The husband and wife built the place building by building. The husband had passed away. The wife was managing it. They're older now. She doesn't know what's going on. There were
Yeah.
40 units. She had no idea who was renting them. They just had stuff in them. Some of them didn't even have locks on them. So by the time we closed, she had trashed out 10 of them by just calling the uh, Habitat for Humanity. And we had 30 units that needed to be trashed out. So we fixed, we got all that stuff out, re-rented it, had a website, redid everything. Her computer was still running Windows like 95. I can see it to this day. It was wild. This is
That's
in
great.
2017, I think it was.
Yeah.
So we fixed all those problems, got it from like, I don't know what the number was. I forgot, like call it 70%. It's close to 60 something, but 70% occupancy, got it close to 90% within 60 days by just putting a website up there. So can you find them on LoopNet? Number one, the second deal I found for passive was off LoopNet. So can you find them on LoopNet? Yes. Are they needles in the haystack? Yes. Are they kind of rare sometimes to find something like that? Yes, but they're out there. So I think it is possible. I was going to say too, in any economic climate, it doesn't matter. It was hard to find deals back then. I don't know how many offers we made, and sellers we couldn't come to terms on price, etc. So it's hard today. It was hard back then. It's gonna be hard in the future. It is what it is. You just have to build your funnel, look at 100 deals, and then hopefully get one, two, or five, or hopefully three, four, 20 of them under contract if I can count numbers. But put a bunch of them under contract, as many as possible, and then hopefully some of them close. So that's really what it comes down to. It's just a numbers game. We'll see some distress probably, but I think we've missed the boat on that.
Man, I can't believe it's 5:29 already. We're 29 minutes into this, and I'm gonna have you come back on again sometime because
Oh
it's
yeah.
just there's so many things that I could have talked about that I have sitting here that I wanted to ask, and we'll do this again for sure. But I want to encourage the people listening: go follow this guy. If you don't follow him on LinkedIn, do it. His podcast is fantastic. I'm going to give you an absolute shout out because I can still remember the day I saw your post on LinkedIn where you made the commitment to get back into podcasting.
Oh yeah.
And
Yeah.
I'm very grateful because in like your first month of podcasting, you got some absurd million plus something downloads. I can't remember what the exact number was, but it super motivated me to get more serious about what I was doing with my podcast. So, and that's the way I always view that. Like, I don't view you as a competitor. I view you as somebody that is going to help me raise my bar. And so I just wanted to give you a shout out and kudos because you're doing an amazing job with your podcast, not just because you had me as a guest, but because of how many great people you're bringing on there. And I will say this, I'm a snob when it comes to interviews. Your questions are fantastic. You do such a good job of really diving deep into things. And I was blown away by that. So people listening, go follow Chris, the Storage Investor Podcast, listen to it. Someone wants to talk to you. They want to dig a little deeper into what you're doing with passiveinvesting.com. What's the easiest way for them to get a hold of you?
You know what? I'll let you know here. Actually, I'm going to go my own way. So yeah, it's kind of interesting right now. I have my own LLC. I've had it for a while, Bennett Investments. I'm going to end up doing that. I think run something with that. I have a few other partners to do self-storage, industrial, outdoor storage, flex warehouse space. So we're going to be adding a few other asset classes as well. The podcast Storage Investor Show. Please check it out. Happy to have anybody give me some feedback, listen to some episodes, leave a review or whatever. But you can hit me up on LinkedIn, Instagram, X, YouTube as well. Go on the YouTube channel. Don't go there just yet. I'm just kidding. Go there. It's a little bit embarrassing. I'm trying to make it better. So don't worry. That's coming along. I'll have a website here pretty soon as well. StorageInvestorShow.com, StorageInvestorShow.com. But I'm on all the social platforms as well.
Breaking news. I love it. Chris Bennett, if you're listening and not watching, KRIS Bennett, 2 N's, 2 T's. Look this guy up, an awesome follow. And Chris, want to thank you, as I said, for joining the Self-Storage Made Simple podcast. Want to take a quick second to thank my friends at PropRise, the sponsors of our podcast, been such great supporters for us. Get a chance, go check out proprise.io. They are amazing, an incredible tool to help you supercharge your search for both existing assets and raw land in the self-storage space. So shout out to PropRise. Chris Bennett, look forward to having you back on again soon.
Thank you, Thaddeus. Appreciate it, man.